get more on China, let's bring in our next guest, Jim Oberweis. He's president and portfolio manager of Oberweis Asset Management. Jim manages the Oberweis China Opportunities Fund, which performed better than 98% of its peers in 2009. He joins us right now from Chicago. Jim, good to have you with us. You know, we've seen the pullback in Chinese stocks over the past month, the concerns. Now, at this point, we're seeing investors thinking, well, maybe they were overdone. What do you think? Were they overdone?
Well, look, we're seeing tighter credit conditions in China, but they're tighter from very expansionary. So I don't think there's that much to be concerned about. In fact, I think the government is taking very prudent measures so that you don't have a bubble. I think that's normal. I think the growth rate and the loan growth that we've seen over the course of the past 6 months was tremendous. They're just bringing it back under control. None of the real factors, I think, that led us to invest in China, those being things like the rise of a middle class in China, like a massive infrastructure upgrade, the urbanization from the countryside to the major cities, none of those things are really changing. And that's like, all those are likely to last a decade or more. So no, I think that the story is fundamentally sound, and you can buy it at a little bit cheaper prices than you could have a month ago.
What about people who have an investment horizon of less than a decade here? I mean, what's your time window look like when you're investing in China? Because clearly, if they put the brakes on, it's got to have an effect, at least in the very near term.
Yeah, I think it probably will have an effect in the near term, and that effect is probably already taken account in stock prices, or at least most of it has been, I think, at this point. If your decade is, I mean, if your investment horizon is a year or 2 years, I really don't know that China's the right place for you to invest. I don't even know if the stock market is the right place for you to invest. But as time goes on, if you have 5 or 10 years, I think the real question is, how can you not invest in China?
You know, I don't disagree with you, Jim, but I mean, everybody keeps talking about the ramp up of the domestic consumer in China. I mean, that's going to take an awfully long time, isn't it?
Well, I don't know. I mean, 15% growth in retail sales is really nothing to scoff at. I think it's a lot more than we have here anyway. So it's all on the margin, Carol. You're talking about such a huge population that if, let's say, 10% of that population becomes consumers, that's roughly, you know, a third of the U.S. market. So I think you're talking about marginal growth that could last for a very, very long period of time.
Let's talk about valuations, because you say that, especially after this year-to-date correction, they've gotten back to good levels to get in. Where do you think Chinese stocks are fairly valued, and what are you looking at right now in your fund?
Yeah, sure. I mean, if we look at our fund, we're looking right now at about a forward PE of 18 times earnings for an average growth rate of 27%. Certainly isn't exuberant. The absolute numbers are high, except when you compare them to the growth rates that you're buying. We're certainly willing to pay those types of PE ratios for very high rates of growth, and we're finding those in China. Certainly, I think if you get to 25 times earnings and you don't see a change in the growth rate, well, that would be something that we would be a little bit more concerned about. But that's an awful lot of appreciation between now and then. And you can't, frankly, you can't find those types of growth in the U.S.
Jim, no doubt about it, you're very optimistic about the outlook for China. What about, though, kind of the political, the policy side of it, whether it's trade wars, you've got the president talking about going to meet with the Dalai Lama. I mean, there are a lot of tensions or perceived tensions between China and the United States. How might that impact the investment outlook?
Yeah, Carol, let me tell you, I'm long-term optimistic, but I think there are going to be bumps along the way. And probably some of the tensions we're seeing right now, that could be one of those bumps. If you look at it from a prisoner's dilemma point of view, meaning what is rational for all the players in the game, a trade war isn't rational for us. It isn't rational for China. It's not rational for anybody. Now, at the same time, when you get populist rhetoric going, sometimes you get irrational outcomes in those types of situations. So I think as long as everyone keeps their cool and they sit down and they think things through, a lot of this will be diffused. There certainly have been plenty of instances in the past where that hasn't occurred, particularly during rougher economic times, and we're seeing some of that in the United States.
That's where we are right now. Is it your biggest concern? Is it the biggest headwind outside of the easing or the reduction of the easing that we've seen?
Well, I think there's probably two big concerns. One would be trade wars that significantly affect China's ability to export. And I think the other one would be a global recession that really continues and really affects China beyond where their infrastructure can pick up some of the slack. That could put political pressure on the government. Certainly during bad economic times, we've seen revolutions. That's how Mao got power. And that is certainly one of the things that's in the back of my mind. But I don't think that risk is a high percentage. It's high consequence, low percentage type of event.
All right, hey, Jim, thanks so much for spending some time with us today. Jim Oberweis from the Oberweis Asset Management Fund talking about China. Now,